I'd like to thank everybody for joining me today. Today, I want to talk about long-term care options for our clients. If you think about long-term care, it's designed to protect the family, the cash flow, and flexibility before the care is needed. So this is planning we need to do now so that we are prepared, our clients are prepared for the future cost of long-term care. Let's start looking at what does long-term care really mean? With long-term care, the care is triggered when everyday independence changes. There's a lot of things that we do on a daily basis when we're healthy and everything's just great that we don't even think about. So when you start looking at these, what long-term care really helps with, it helps us or our clients with the basic daily activities. And these are also the triggers we look at in long-term care policies to see if that policy is going to be able to start providing benefits. So with this, there's 6 activities of daily living. And if you think about these, we don't even think about these, we just do it. So it's transferring, toileting, bathing, dressing, eating, and continence. Those are just things we go throughout the day that we just don't think about. But these are the things that trigger the long-term care policy benefits. And to trigger the benefits, it comes to the point if you can't do 2 out of those 6 activities of daily living, then you're going to get benefits from a long-term care policy. And the or is important because a cognitive impairment such as dementia will also trigger the long-term care benefits. So it's not both. It can be either 2 out of 6 activities of daily living, or we have a cognitive impairment. And if you think about this, we need long-term care planning to begin before we have a health event that's going to trigger these kinds of needs. So you start looking at, we don't, when we're doing helping clients with their retirement planning, what's it going to be like for you in retirement? We need to really pay attention to the cost of long-term care. Nobody pictures their retirement years needing help. We don't look at it in a nursing home bed. We don't look at it in an assisted living facility receiving cognitive care. All of those things we have to realize can happen, and there's a high percentage that it's going to happen too. But we have to look at how are we going to address that when those things happen. So the big part of this is, how do you pay for care? How does it really get paid? Well, the first thing we can look at is self-pay. And I see some advisors that will say this is self-funding. And I don't like the word self-funding because it actually sounds like you've got some kind of a plan. Self-pay is you're going to reach into your current savings, investment assets, or income to cover the cost of care. Now, the biggest problem we have, a lot of clients in retirement are living off their qualified plan money, their IRAs, that retirement income that they've saved. Well, think about this. If they need $100,000 to cover their care this year, well, they don't reach into their IRA and grab $100,000. They have to grab $100,000 net after the taxes are paid. So you've got to gross that up for the income tax that Uncle Sam's going to take from that qualified plan money so that you have a net amount to pay the long-term care bills. Now, this becomes a problem when we're working with spouses. What happens if the first spouse needs care and we use up all the retirement assets to cover that care? What about the remaining spouse, the surviving spouse at that case? That well spouse needs retirement income. There's bills to pay, there's home, expenses, whatever it is, but we're sucking all that money away for long-term care. So self-pay, it can work. It can be expensive, but we've got to look at that on a true after-tax cost to see, is it viable and feasible for our client to cover those costs? A lot of people will say, well, I'm going to look to the state with Medicaid, Medi-Cal, those types of programs. Well, with Medicaid, it is designed to be basically your broker on your way to broke. And as soon as that happens, then the state will step in and pay. But they get to pay at the level they want to pay. And most facilities, there's a difference between people that are paying out of their own pocket or paying with long-term care insurance money versus those that are receiving Medicaid. You're getting taken care of, but maybe not at the facility or the level that you want. So I don't know if that's a real answer versus, hey, it just happens and that's what we're stuck with. Finally, you can transfer part of that risk or all of that risk over to an insurance company. Basically, you're going to fund a policy now that will trigger for these benefits to be paid in the future, but you're going to leverage that money and leverage it for a bigger benefit when the long-term care needs arise. And so you look at each of these options and look at the cost, control, and family impact of what they how you pay for this coverage or how you're going to pay for the care. All of those options need to be explored to get to the best answer. When I look at what most people think from insurance, and when you start looking at and talk to them about insurance, they think, okay, I want a death benefit. What happens when I pass to take care of my spouse, heirs, business, whatever? And the nice thing about these with the new long-term care products, they're called hybrid products, hybrid policies. These hybrid policies are built on a chassis, either a life insurance policy or an annuity. But what I like about this is if you don't ever use the long-term care, there's going to be a death benefit that will pay back to the family. And that will, in most cases, be at least the amount of premium you paid in. So you lose the opportunity cost that could have grown to over the years, but your family gets paid because the benefit was never used. If you do need to use it, then we've got a plan in place. I also like these new hybrid policies because most of them have a cash value. Because let's be honest, life changes. And life may change to the point where you need access to cash now. Yes, we built this for long-term care. We had the backup plan that if we didn't use the long-term care benefit, that there would be a death benefit back to the family. But what if you need money now? So these policies, I like this for the fact if you need access to cash and cash value, you can go pull that out of the policy depending on the terms of the annuity or the life policy it's built on. But you've got access to that cash now for the whatever has happened, and you can cover those goals and objectives that are happening now. Finally, if 2 out of 6 activities of daily living are met, you can't do 2 out of 6, or you've got a cognitive impairment, and it's to the point where you need care, you can trigger the long-term care benefit of that policy. And the best part of this is it's leveraged out to where you're using potentially the insurance company's money to cover your costs. So it limits the amount that we have to pull out of retirement accounts or current assets that may be structured to take care of the other spouse, maybe there to take care of our family or other obligations. But now we have death benefit, we've got cash value access, and we've got that long-term care need covered the most efficiently way possible. And if I look at this, when I talk to a lot of clients, they need this combination of all 3 goals. So all of these things are important to us in the planning process. They're very important to our client. We need to listen to our client and help them get the best plan. The right design is going to have protection, flexibility, and provide that legacy back to our heirs as we need to. So all of this can be built into an overall comprehensive plan as long as we're working with our client and understand their goals and objectives. So it's not a product. We're not looking to just get the right product. We're looking to get the right fit. So when we work with our clients, we want to make sure we're asking them questions of, what do you see now? What do you need to be protected about in the future? And making sure that we're doing this before the health issues arise. Plan early, and make sure we have the most choices available. And if you look at this, we're matching the best strategies against the care risk and the financial ability for our clients to either pay for the care or pay, and move some of that exposure to an insurance company. All of this is good planning of options for our client, but we need to start now and let them know what their options are. I appreciate everybody being on. If you have questions, reach out. If not, we'll talk again next week. Thank you.